Well, our next guest needs no introduction. It is Michael Saylor from MicroStrategy. And I'm the one who probably needs a bit of introduction, if you're like wondering, who's that random British man talking to me right now? I'm Connor Sephton, and I am a journalist for CoinMarketCap. I host their daily podcast. Michael, thank you so much for being with us today.
Yeah, happy to be here.
Fantastic to have you. And just a reminder, if you are watching us on YouTube or in the metaverse, you can send some questions to us. Just leave a comment on YouTube or go to our Discord channel, and I will ask them to Michael later on in the panel. But first, Michael, you said recently that this entire crypto crash could be a good thing for Bitcoin. What did you mean by that?
Well, I think if you look at the entire crypto universe, you have a lot of different creatures. You have crypto commodities, you have crypto securities, you have crypto exchanges, you have cryptocurrencies. And then you have a set of applications and protocols that interlace with all of these instruments. And what you have is a bunch of people in the ecosystem that don't necessarily understand or have the information to make the best decisions. And you have a lot of people outside of the ecosystem that are afraid to enter the ecosystem because they don't have the clarity they need. So for example, what's a currency? Well, a stable coin is a currency. In theory, if I can move $1 million from me to you without incurring a tax bill, that looks like a currency, a stable euro, a stable yen, a stable dollar. There's a huge amount of demand for it. It's probably $1 trillion to $5 trillion of demand for it. Everybody wants it. However, you have three different types of stable coins off the top of your head. You could have stable coins that are backed one for one with dollars, and they look fairly secure. You could have if you saw $10 billion of that stable coin with $10 billion of currency equivalents backing it, or cash equivalents backing it, then that's something that you probably could trust and put a lot of weight on. There's another set of stable coins that are backed by something. Let's say maybe they're backed by equities or they're backed by debt, and maybe I build a stable coin with $10 billion of junk bonds backing it. Not quite as, and the $10 billion of junk bond, maybe I have $10 billion of real estate backing a stable coin. They're not liquid. They're not mark to market. It's still something tangible, less tangible. And then the third stable coin would be, I just issued $10 billion of stable coins with nothing backing. They're all quote unquote stable coins. But one of them, like UST, collapsed to zero because it literally didn't have anything backing it. Or maybe the backing was 5%. It might have been back 5 or 10%. I don't think they had $18 billion worth of cash equivalents. So they probably didn't have $18 billion of real estate or junk bonds backing when they got to 18 billion. They had $18 billion worth of Luna, right? And so what you have there was something highly risky, but not perceived as risky because there's not really clear disclosures. And if you'd asked 1,000 people, what's the difference between UST and Tether and Circle? They couldn't tell you. But that would be the three examples, right? Sort of Tether's in the middle, Circle's on one extreme, UST's on the other side. So this crash is going to cause a lot of clarity to form there. First, the community is getting educated, right? I bet you everybody in the crypto community today knows the difference between a dollar in the bank and UST. And I bet you they have an intelligent conversation about the difference between Circle and UST and the business model of the two. And we saw last week, Tether had to redeem billions and billions of dollars of Tether, and they could, right? So they could. But if you'd actually tried to redeem $7 billion of UST in a couple of days, well, people tried to do that and they couldn't. So I think the industry got educated, but also I think that there's a lot of people that would like to issue stable coins, like Caitlin Long's bank would like to issue stable coins. And if you look at the banks like Silvergate and Signature, they're FDIC insured banks, but they can't issue stable coins. So, and if you look at JP Morgan and Goldman Sachs and Citigroup, they can't issue stablecoin. Now, if you roll the clock back 6 months, the president's working group put out a memo on stablecoins. And when they put out the memo, they said, we'd like for FDIC institutions to issue stablecoin. Now, putting aside whether you agree with that or not, there's been a regulatory deadlock on Capitol Hill, because in the 6 months after they put out that memo saying they think that banks should issue stablecoins, no bank issued a stablecoin. And that's because the president's working group memo said, well, Congress should pass the law making this clear. And until then, we'll think of it this way. So the banks are waiting for Congress to pass the law. Congress didn't pass the law. And all the way up until last month, there's really no clear consensus to move on this. And we didn't expect any clear legislation or regulation before 2023 or 2024. So I think that if we just take the example of stable coins, that crypto crash and the UST crash has simultaneously educated the existing crypto market and all the investors. It's also introduced, the concept of risk. There are different, not everything is equal, right? There are 19,500 things, on CoinMarketCap, but they're not all equal. So to say, well, this is risk-free or that is, they all have different flavors of risk, but how do you assess the risk? Mm-hmm. So I think that the industry is getting more sophisticated. I think that the regulators now have some pressure. The Secretary of the Treasury was in a congressional hearing with Senator Toomey, and he's been an advocate of some stablecoin legislation. And he asked her, you think we need to get it done this year? And she said, yeah, I think we can and should get it done this year. So the consensus among the regulators and the politicians is, yeah, we probably need to do this. Now, you could say, if you're the crypto anarchist, I hate regulators, I don't want them to do anything. Well, that's one way to view it. But as long as they don't do anything, the industry stays $1 trillion, $1, $2, $3 trillion. When they do something, then you're going to see people like, let's say David Solomon was on CNBC last week. He's the CEO of Goldman Sachs. Well, whatever Goldman Sachs thinks is probably what JP Morgan thinks and Citigroup thinks and Bank of America thinks and Wells Fargo thinks. So what he says is, yeah, we know the crypto economy's here to stay. We can't custody it yet. We're afraid to custody these assets. Like we're not allowed. His actual words were, "We're not allowed to."
Right.
And if I speak to CEOs of publicly traded companies and banks, like publicly traded banks, they'll say, our regulators won't let us. So you see the conundrum here, which is you could either stay in a regulatory gray zone where there's about 1% of the money. You can be 1 or 2% of what you're going to be, and you can stay in the gray zone. Or you can create a clear public policy framework, and then you move into this compliant zone. And when Goldman Sachs and JP Morgan enter the space, they'll issue $500 billion of stable coin, trillions of dollars. And so you'll go from 150 billion to 1.5 trillion. And when they start issuing in that size, you'll see Amazon and Google and Microsoft using stable coin for international remittance and corporate remittance. And then you'll see it get built into Apple Pay and Google Pay and Amazon as a payment method, right? And then you will actually see billions of people using this stuff instead of hundreds of millions or tens of millions. So I think that the consensus is the regulators need to provide more clarity on this issue of stable coins, and they also need to provide more clarity on the requirements for a crypto security. Right? It's clear that Luna was a crypto security. The reason it's a security is there's an issuer and there's someone that can make decisions. And if I can actually make decisions, if I can take $3 billion and buy Bitcoin, and then I can take the same Bitcoin and sell it on behalf of the people that own the Luna token or on behalf of the people that own the UST token, I'm acting, kind of like a public company officer, like, and if you're a public company, like think about MicroStrategy. Like if I just sold all of MicroStrategy's Bitcoin and I didn't tell you, right? Or if I bought twice as much and I didn't tell you, I would be changing the nature of the security. I have, kind of an obligation to disclose that, an ethical obligation as well as a legal obligation to disclose what I'm doing when I can actually impact the value of the securities held by the public. So I think that this is going to accelerate that regulation. It'll accelerate the regulation of the crypto securities, and which are many of them are unregistered securities, and there's no disclosure. It'll accelerate the regulation of the exchanges. It'll accelerate the regulation of the stable coin. And in the near term, there'll be a shakeout. So, some things, when you look at them in the light of day, you'll say, for example, what's a shakeout? I decide I like Circle better than I like UST. That's a shakeout, right? Right. And it'll also create an on-ramp for institutional intervention, because you've got $300 trillion worth of money, that's $100 trillion of bonds, $100 trillion of equities, $90 trillion of currency derivatives, all sorts of forms of money. You've got other sorts of derivatives. They're all sitting out in the mainstream economy. And if you might have seen my tweet of Ken Griffin. Ken Griffin gave a speech last week to Bloomberg, and they asked him about crypto, and he said, look, the market deserves clarity from the SEC or the CFTC. What's a security? What's a commodity? And every day ETFs publish their holdings. If you own it, and there's thousands of ETFs, ETFs are kind of like they're derivative securities of sorts. So, if I can buy an ETF and every day they tell me what their holdings are, then I can get comfortable trading it, shorting it, going long it, holding it, et cetera. So his view was, why can't we see the same disclosure on something like a stable coin, right? We should get some periodic disclosure. And then he ended his discussion with kind of like a degree of frustration, like it's overdue, like it's time to stop screwing around. And if we have regulatory clarity, it's going to open the way for tier one firms like his own, like Citadel. But what he really means is Goldman Sachs, JP Morgan, Citigroup, Bank of America, Wells Fargo, Citadel, all of Wall Street. It'll open the way for them to make markets, do research, right? And to provide liquidity. And provide liquidity eventually means loans, and as well as hold on their balance sheets.
Right.
And they're not going to do it as long as they don't know the difference between a commodity and a security, and they don't actually understand the legal status of these things. So ultimately, what you've got is a $1 trillion industry that'll become a $10 trillion industry if we have regulatory clarity, and then it will become a 20, and then a 30. There's no reason it can't go from $1 trillion to $100 trillion, but you've got to work through these issues.
So you've mentioned that the world needs stable coins and wants stable coins that they can trust. Yeah. So I guess my question now is, which stable coins that are in existence right now do you trust? Would you trust a stable coin issued by a bank like JP Morgan? And would you trust a central bank digital currency?
I don't think there's any consensus or any interest anywhere in the Western world for a central bank digital currency. I don't think the banks want it. It would undermine them. I don't think the population wants it. The banks would look at it as an encroachment on their business. Like Goldman Sachs, JP Morgan don't have a reason to exist, right? So they're not going to want it. And I think that the consumers and the voters don't want it because they think it's an encroachment on their freedom and their sovereignty. So I don't think anybody's going to trust that. With regard to which, if you look at all the existing stable coins, there's not a single one that meets the definition of the president's working group. So there's a debate going on throughout the world. And I think that the answer to what would I trust depends on who I am. If you ask the question, what will a big publicly traded company trust? A publicly traded company would trust a stablecoin issued by an FDIC insured bank. So for example, MicroStrategy is not going to hold either Circle or Tether or DAI or a UST type thing on its balance sheet, because none of those meet the standard of an FDIC insured bank. And from our point of view, all we're wanting to do is move money from point A to point B with no risk. And so there can't be more risk than having the money in a Bank of America or Goldman Sachs. Now, if you look at other players, right? If you're a private company offshore, if you're a company in Venezuela or Argentina or Lebanon, then would you take the FDIC stablecoin? Sure, you would. But you might also take a public company like Circle. If there's a company that publicly issues and they disclose it, I mean, do they disclose it every month, every quarter, every week, every day, continuously? Right? There's an interesting question there, but you might take that. That's kind of like, holding a credit instrument from Visa or American Express or something. You might take that if there were additional services, right? Maybe you think that that's a safer thing than putting the money in your own local bank. Now, if you go further and you ask the question, well, how do I feel? What would I trust if I was in Afghanistan or if I was in a war zone? If you're in a war zone and the issue is maybe you can't get an FDIC approved stablecoin, or maybe, I guess if you're in Russia, you're not going to be able to hold an FDIC issued stablecoin if they have some guidelines or rails on it. The real question is, there's going to be a spectrum of decentralization versus centralization of these, right? Right. Like, for example, Tether can actually block an address. But if I was in outside the United States, I might actually think that I'd rather own the Tether than own the regulated entity in the U.S. Right. Right. So the issue is, how sanctionable is it? A fully decentralized stablecoin, right, is most censorship resistant. That will appeal to someone if you can construct it with integrity, right? No one's done it before. It's not clear. So I think that the market will actually go back and forth over that, and the market will determine. And everybody will have different risk tolerance. And so there'll probably be like 3 or 4 flavors, or there'll be a spectrum. But right now, I think you have 2 extremes, right? You're lacking the totally secure regulated stablecoin from Bank of America. That doesn't exist. And then on the other hand, you have the things like UST, which are unstable, maybe not backed by anything. And that's probably a bit too dangerous for any rational person to hold once they understood what it was.
Yeah. So inevitably now we're going to talk about MicroStrategy and its Bitcoin holdings. Now, you say you're in it for the long haul, of course, and you've said recently you firmly believe Bitcoin's going to go to millions of dollars. But I just want to ask you about the here and now, because right now, MicroStrategy's Bitcoin has a slight unrealized loss, whereas a few months ago, you had a paper profit of $4 billion. Zooming in on this and removing the fact of where you think it's going to go, do you ever look at that and kind of go, oh my gosh, like we were sitting on $4 billion of paper profits and that's now gone?
No. For example, if you'd asked the same question to Jeff Bezos in 2003 and said, you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001?
Yeah.
Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss. Do you wish he did?
That's true.
But you see how foolish that is, right? For example, Mark Zuckerberg, could have also sold Facebook, just before or just after the IPO and avoided a 50% loss. And, in fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. So I think that that trying to time the market is a trader mentality. But if you look at all the richest people in the world, they're not traders, right?
They're hodlers.
Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, right? Larry Page, name the person that traded their way to that situation. You can't really do it. Like trying to time the market is ridiculous. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days.
Yeah.
So if you miss the top 3 days of a year, you might lose 80% of your return. If you miss the top 6 days, you lose it all.
Yeah.
So the way this is going to work is it's going to look like you're not making a lot of money 98% of the time. And then you're going to wake up one day and you're going to find out that the sovereign wealth fund of some Middle Eastern country just bought $10 billion of Bitcoin. It's going to double or it's going to triple. And then you're going to be kicking yourself and screaming, saying, oh, well, I could have bought it at blank and I didn't buy it at blank. And you'll be angry. I think that the trading mentality is just really an awful mentality for anyone that, if you're not running proprietary algorithms on high-speed computers, like I get it if you're a high-speed computer trader and you're like slicing 1/10 of a penny 1 billion times an hour. Like I get that kind of trading, but for 98% of the population, people don't have any proprietary edge to trade. And so generally they all get beat by the market trading. I'll give you some simple stats. Like let's look at since MicroStrategy entered the entire crypto economy, we got involved in the second quarter of 2020. We announced a $250 million Bitcoin buy in August 10th. If you look at the numbers since we actually made our Bitcoin purchase, the money supply expanded 36%. The M2 money supply expanded 36% in the US. Gold is up 7%. Gold didn't track the money supply. If we had bought gold, we would be way lagging behind the money supply. The NASDAQ index is up 19%. It barely crawled forward, but it didn't actually keep up with inflation. The S&P is up 29%. So if you bought pretty much all of the desirable companies in the index, it didn't actually hedge your inflation. It lagged inflation. And why? Because you're owning securities and the corporate management teams have inefficiencies. They're basically an overhead cost. Bitcoin's up 229% since then. And so when you think about that, what's beating inflation? Bitcoin is. What's losing? The traders are all losing, right? And most of the other assets are lagging. And everybody's thinking that they can time the market. But as a practical matter, I think they do a statistic and like 95% of active traders underperform the market. So MicroStrategy's got a strategy, right? Which is we're buying Cyber Manhattan. We're buying up, Howard Hughes went to Vegas and he looked around and he thought, this is a good idea, city in the desert. I'm going to buy it all. But he didn't buy the buildings and he didn't set up the casinos. He bought all the land. Okay. And he bought the idea is you buy the land underlying the city, and municipalities like Summerlin, they're built on top of his land. They're still building things on top of the land that Howard Hughes bought long time ago. Just like it's not a bad idea to own Manhattan. The trading, it's a different business, right? And I just don't think I don't think it's a good idea for most people. But regardless of that, if MicroStrategy was trading, we would just be a public hedge fund. Okay, so the real problem with that is if you're an investor, how do you value a very opaque hedge fund that will do whatever? For example, if I just told you, I bought some Bitcoin, but I also bought some ice cream trucks. I might also have bought some Luna. How would that have worked out? Right? I might.
Not very well.
Right? But here's the thing. There are thousands and thousands of public companies. People want to invest in something that they understand, that they can trust. So if you're going to be a theme park company, that's what you should do. If you're going to be a movie company, if you're going to be an oil company, you should be a pure play, and you should focus, in a laser-like way on that, because that allows a rational investor to put you in their portfolio. For example, like maybe you hate Bitcoin. If MicroStrategy has a strategy, which is we're long Bitcoin, we're levered long Bitcoin, well, then that's good, right? Because now you can short us. It's not a bad thing for people to short your stock, because if they short your stock, eventually they're going to have to cover, right? On the other hand, maybe they like Bitcoin, but they think it's 99% likely to fail. Think about it. You have $100 million, so you put 1% of your portfolio in it, and you want to find someone that actually is pure long Bitcoin, you see? So if we're transparent and predictable, then we allow a rational investor to allocate their portfolio rationally. And they just don't want us to be unpredictable. What happens if we become unpredictable? You see, like, if I'm predictable, you might meet with me, understand what I'm going to do, and say, I wanted to put 5% of my portfolio into Bitcoin, and you might actually invest $5 million after a 1-hour meeting, right? But if you met with me and I said, I'm a genius and I can trade everything and I know when to sell and I know when to buy and I'm going to time the market and I have all these algorithms, you're like, well, maybe you do, maybe you don't, but 95% of the time, those things don't work. And the point is, I have just, if you're the investor, you want to hedge the risk. You don't want the management team to hedge the risk. I'm a black box. So after you meet with someone that says they've got some wacky, complicated trading algorithm, instead of actually investing $5 million, you invest zero and you study it for 500 hours. And so let me put it a different way. You could probably raise $1 billion in one day if you're predictable, even from people that don't even like Bitcoin. Whereas if you're unpredictable, you could work for 1,000 days and raise nothing. So you get where I'm coming at. The world wants certainty. It wants clarity. It wants conviction. And it wants you to execute with focus. So it happens that we believe in Bitcoin. But there are plenty of people that trade our stock. You could buy our stock and go long our stock and short Bitcoin, you see? There are people that may actually invest in us that don't have our degree of conviction, but they respect our clarity, they respect the transparency, and they respect the fact that we're predictable. And it's very important in this world, of chaos, that you actually stand for something.
So I guess my question now is, and I'm looking at kind of specifically how Bitcoin's performed year to date, because that's when we've seen inflation in the UK and the US reach 40-year highs, even worse in other countries such as Turkey. Do you think that we haven't really seen everyday consumers, and to an extent some companies on the stock market, meaningfully invest in Bitcoin despite this high inflation that we've seen? Do you think that the message from Bitcoiners like yourself is getting through?
I think that when you're looking at modeling this, you have to be aware of timeframes. For example, a lot of people, they want to read a headline and then they want the price of the asset to move the way they want it to move immediately or the very next day. But in fact, there are very long time delays in these things, 6 months, a year, 2 years, 3 years. So I think that as I pointed out, if you look at the 2-year, the 4-year, the 6-year time frame, Bitcoin is acting very rationally per inflation. But if you look at very short time frames like 6 weeks, you may sometimes get the opposite of the expected effect in the near term, because you've got other drivers. You have traders that have large pools of capital that are trading with a different model that are dominating the market in the near term. So I think if you're going to invest in the asset, you have to have a clear idea. Are you a trader or are you an investor? If you're an investor, you have to have a 4-year time frame. Mm-hmm. And then you can only start to make conclusions after you've waited a couple of years. If you're a trader can make conclusions faster. You just look at the correlation. You say, well, NASDAQ traded down 2% today. Did Bitcoin trade down 2% or 4% or 1%? And you're building these back-tested correlated models. And I suppose that works fine. But again, I just think that they're just not intellectually defensible over the long term. Like, for example, the Titanic hit an iceberg. Everybody ran to the deck. Okay. The Titanic sailed into the sunshine, and it's a beautiful sunny day, 75 degrees. Everybody came to the deck. Okay. So you've got a statistical model. Everybody runs to the deck. You say, oh, the sun must be shining. It's a great day. Or you built your model and you say, oh, everybody ran to the deck. We must have just hit an iceberg. But you see, at the end of the day, it does matter whether or not you hit the iceberg or not, or whether the sun is shining. And the statistical model won't tell you the difference between the one or the other. Both of them have a lot of people standing on the deck of the ship. Right. And so I just think you got to think more fundamentally about these things. I mean, not too many people are thinking about the fundamentals, at least in the near term. I joked on Twitter, people with less knowledge and more money than you set the price in the market. Over time, they will get the knowledge, you will get the money. Right? Over time, what really matters is the underlying fundamentals, right? And in the near term, you have panics, and the panics cause like risk off events. Like people panic because inflation is really high, and so they sell the inflation hedge. Huh? Tell me that again. Inflation is really high. The government can't get it under control. So there's a panic. So people sell the inflation hedge. And then the journalists and the modelers say, well, look, we've run a statistical model for the past week, and it shows that when inflation is high, people sell Bitcoin. So it's not an inflation hedge. Huh? Well, if you run the model over 2 years and you look at it since COVID, you can see it's up 229%. And it's pretty clear that gold is not an inflation hedge, and silver is not an inflation hedge, and stocks are not an inflation hedge, right? And bonds are not an inflation hedge, and currency is not an inflation hedge. That's pretty obvious if you look at it over 2 years. But if you shorten your time horizon to 2 weeks, you can come to the opposite conclusion. But in my opinion, it's pretty foolish to come to that conclusion. But it is, that's the market, right? I mean, there's going to be someone that's going to take the other side of the trade, and they can be right in the near term, and they'll be hideously wrong in the long term. And you can't be right in the long term and still be right every day in the near term, right? Like Jeff Bezos had to look stupid 6 times in a row in order to be the richest man in the world. And so the question is, do you want to be right in a decade, or do you want to be right tomorrow? You choose.
So I'm mindful that we're running out of time. So I just want to bring in some questions that we've received from people watching on YouTube. And this is from Janik. Hi, Janik. Apart from the great potential that Bitcoin offers, how much does Michael think the price patterns are controlled by smart money to shake out retail investors?
I I think there's a lot of randomness there, but the truth is I don't have any particular opinions that I'd like to share about the near-term price patterns. I'm not a trader. What I think is eventually one day you'll wake up and some country will buy $20 billion of Bitcoin and it'll jump by a factor of 3. And that'll be the thing that's going to drive the price long-term is going to be intelligent regulation. As the SEC, the FDIC, Treasury, as FASB, as they issue guidelines, as big institutional investors and big banks get into the space, as countries get into the space, I think that'll drive the price up. And I think in the near term, trying to guess what the price is going to be is a losing proposition. So I just don't think it's a good idea to even try.
Yeah. And you mentioned, I saw a quote from you recently, which I think you mentioned hostile regulations. And I just wanted to ask you, are there any particular types of regulation that you think could ultimately not be a good thing for the crypto industry and for Bitcoin and actually harm Bitcoin's future development? Is there something that a government could do which would really stymie Bitcoin?
I think generally, first of all, you have to separate. There's 19,500 cryptos. There's one Bitcoin. I think that most regulation is going to create turmoil for the 19,500 cryptos. There's going to be a shakeout. So regulation generally is good for Bitcoin, and it's difficult for the rest of the cryptos, right? They're on the opposite side. But it is possible to construct a very profitable crypto exchange and a very profitable cryptocurrency, a stablecoin business, and a very profitable set of crypto securities with regulation. It's just that's going to be a lot more work. I think that generally just about all regulation that's contemplated anywhere in the Western world is going to accelerate mainstream adoption of Bitcoin. Bitcoin should get 10x bigger and then 100x bigger. And the thing holding it back is the fact that there's no regulatory clarity in the crypto industry. So yeah, I'm not really concerned about the regulation.
And lastly, Michael, what do you think are the best ways for people to learn about Bitcoin? A lot of Bitcoiners often say, once you understand Bitcoin, you'll think differently about it and you won't see the criticisms of the space the same way. What would be your advice for somebody who's still a bit skeptical about Bitcoin, but is interested in learning more?
I think that if you haven't spent 100 hours studying Bitcoin, then you really shouldn't express an opinion one way or the other. I think you should put 100 hours in. And the best way to learn that is you can go to hope.com. We've got tons of materials. You'll see books, research, courses, interviews. They're all free. There's a free 12-hour course, Bitcoin for Everybody, on Saylor.org. It's free. There's a ton of courses. Gary Gensler's course on blockchain and money is uploaded. You can find that. I did about a 20-hour series with Robert Breedlove. That's uploaded. You can see that. You can read the Bitcoin Standard. I think you should probably, before you spend a dime in the entire crypto industry, I think you should read the Bitcoin Standard. There are a bunch of other good books that are also pointed to. So I would go there and look at all that curated stuff, and then I would work my way through those. There aren't very many times in your life where you could spend 100 hours to understand a new asset class. In fact, in the last 30 years, there hasn't been one that I think of. The closest thing to this idea would be the S&P index that John Bogle popularized in the Vanguard 500. But that wasn't nearly as powerful an idea. That was a weak idea of an equity index, whereas Bitcoin is a very powerful idea of a property index. So I would do that, and I would spend the time.
Okay. Lastly, and this is a mischievous question. Is there anything about Bitcoin that you don't like?
Only that it's misunderstood by so many people.
Fair enough. Well, Michael Saylor, MicroStrategy CEO, thank you so much for taking the time to join us. It's been fascinating talking to you and hearing your perspectives.
Yeah, wishing everybody the best.
Thank you very much.